Welcome back to Lamb's Cryptoverse. So today, the S&P hit a new high, but I'm really worried. I think, and I'm saying this with high confidence, that the market's topping out. And what I want to do is refresh a PowerPoint presentation that I gave a month ago when I said I think the market's going to top out around January. And I said, even though my indicators were negative in December and bearish, I said the market would top out in January because of the seasonal factors. And those seasonal factors are going to be wearing out within the next few weeks. And I think, so this is the perfect time to say that the market's topping out. So I'm going to go over a few of the charts that I mentioned. I'm going to refresh some of them and go online live to show you what they look like. So I'm going to go through this quickly. So pay attention. Okay, this was the list, and let's go over them. So the first one is the Fear and Greed Index. This one was at 68, which is like greed. It's a contrary index, and now it's around 72, and actually hit a high at 77. So that, my friends, is very bearish. The next one is Crypto Fear and Greed. This one was saying that crypto is topping out, and which is it did. It turned out, like I said earlier, we would have a sell the news event when the Bitcoin ETF came out. And so this indicator was a canary in the coal mine. It alerted me that Bitcoin and crypto was topping out. Because remember, this is yet another contrarian indicators. I find all the best indicators, and most of them tend to be contrarian indicators. The VIX index is very low and remains low. As of today, January 19th, it's around 13.1, which is at a level where the market's topping. I'm going to skip this one. This is implied volatility was pretty low for Bitcoin and Ethereum, which is another indicator why they're both topping out. But I also didn't want to use it because of the ETF. I think the ETF caused distortions in the derivative data for Bitcoin. Internet search trends remains bearish. There are no people, nobody searching for a bear market on Google. Options data, the put to call ratio is very low. And let me just move myself here. It's very low. And again, this is a contrary indicator. When it's this low, it means that the market is topping out. And you could actually see in the red line that it moves inversely with the S&P moves inversely with the put to call ratio. And I'm going to show you these other ones now. This is futures position. I'm going to get you a live chart for that. And this is a percent of stocks above the 50-day moving average. These are stochastics. And so maybe I should go to that right now live. And you can see here that I mentioned S&P. I think I'm just going to focus on the NASDAQ. Everyone's talking about how well the NASDAQ is doing, especially the NASDAQ 100 and the QQQs and the Magnificent 7/FANG, whatever you want to call them. And you can see here, this is commitment of traders. And in green, that green line, when that line goes higher and above the red line, that means that future traders and hedge funds basically are bullish. So they're buying long futures options. They're buying bullish futures options on the NASDAQ. So that's a contrarian indicator. So that when that green line is high the way it is now and much higher than the red line, that means the market is likely to reverse and to go down. And here's the one for S&P. And this is what I was talking to you earlier about the percent of stocks above the 200-day moving average and 50-day moving average. This is a stochastic. And it tends to reach a certain level and then go down, except during extreme situations like we had back here in 2021 and 2020. And that overreaction has to do with COVID-19, of course. And then for the percent of stocks above the 50-day moving average, again, it's a stochastic. It reached 85 and now it's going down. And it doesn't tend to stop here. It tends to go down back to this low level. And this is like in the 20s level, for example. You can see where my pointer is. It can go down to as low as 15. So it's a very bearish indicator when it's coming down from the high. So let's go back to the PowerPoint presentation, refresh some of this. So I said we have a resistance level in S&P. We just broke that resistance level, which is actually short-term bullish. We broke it and we hit a new all-time high in S&P. So this is why I'm saying we may have another week or two before the market actually tops out. And this level actually did not work. It worked actually for the Bitcoin price. Bitcoin hit around 48, 49,000. It was a candle, basically, candle formation. It hit that level and everyone started selling. And this coincided, by the way, with the approval of about a dozen Bitcoin exchange traded funds. So it was a seller news event. And I kind of knew that was happening because of that crypto fear greed index, which I mentioned to you before. And we were going to skip some of these, but there was a lot of long positions in futures, basically. And liquidity, I'm going to go through this quickly. It's going up, so that's why everything's going up, but it's not going up quick enough, which means the S&P in crypto may not be sustainable. That up move may not be sustainable because the liquidity is not going up quick enough. These are three new charts I added. The first one is an NAAIM chart, which is a survey of professional asset managers. It's similar to the B of A chart. If you know the Bank of America Merrill Lynch chart, it's similar to that. Basically, when this chart is above 80, that's the orange line here. When it's above 80%, it means that asset managers have very long equity exposure. They don't have too many shorts. And that tends to coincide with market tops. And you can see in purple, you've got the S&P 500 overlaid with this chart, with the chart of the NAAIM. You could see that it does move together. So it just shows you how asset managers, even professional ones, tend to be performance chasers. This is another new one. This is corporate insiders coming from the C-suite. When the level goes below zero point 0.4, especially if it goes below 0.3, that's very bearish, and we're at 0.22. This means that chief executive officers, CFOs, and whatnot, and large insider holders are selling. And so that's a very bearish because these guys, there's like no one else that knows what's going on with their companies as well as corporate insiders. And by the way, I also looked at this number for the technology industry, including software and hardware, and it's at a very low number. And I don't need to tell you, if you watch the news, especially the news headlines coming in every day, you could see that there's a lot of corporate insiders selling. And last but not least is this is a prop algorithm I created. It's basically I call it the daily indicator, but I do a moving average on it. It's basically a technical indicator and it compares basically what the market's doing, in this case S&P, with what's going on underneath. I'm going to give an example. Sometimes people say there's negative or diverging market breadth, and that's what this does. But it looks at more things than market breadth. It looks at coincident indicators. For example, the price of gold, the price of silver, platinum, interest rates, treasuries, the high yield market, investment grade market. It looks to see what other markets are doing, because those other markets should be behaving similar to what the S&P is doing. So if the S&P is going up rapidly, it's going up quickly, that means the high yield market, for example, should be rising. And right now, I'm going to move my video here. Right now, you can see that we're a low level. So I use this basically to confirm in market time my other indicators. Does it work precisely? No, but that's not the point of this. You could see in March of 23, it worked precisely. It gave, it was very bearish, so it gave a sell sign just at the market top. But look, it's not right all the time, and I admit that. But that's not, like I said again, that's not the point. Those other dozen charts, that's the point. Those are core charts I use. I'm not pulling out anecdotal charts to say, hey, this chart supports my point of view. No, these are charts I've used over many, many years. And when they're bearish, I'm bearish. So it's not the other way around. I think I've talked about everything else. Maybe I'll just talk about one little chart here. and that's the fear greed index. This is pretty interesting. I mentioned to you earlier, but I like this chart here because it overlays the S&P 500 historically. And you can see when the fear and greed index is above 60, 70, and that means everyone's exuberant, they're all bullish. You can see the market tops out at that line. And actually, they have a dotted line here where my pointer is. And you can see most of the time when that blue line is approaching that dotted line, that red line, S&P, tops out. It happened here, it happened here, happened here, it happened here. Okay, we didn't hit that gray dotted line, but you could see that we peaked in bullishness at that time, and that's when S&P peaked. And there was a big peak in S&P 500 before the Fed raised rates back in November, December of 2021, and you could see that it also peaked there. So this is a very interesting chart. So all in all, the indicators are very bearish, and the only thing now that I think could keep the market sustaining a short-term rally is seasonal indicators. For example, we're in the beginning of the year, and asset managers and pensions for whatever endowments, they tend to allocate money around this time of year. So the market tends to go up at this time of year. And there's also other factors. For example, in December, you have a lot of tax loss harvesting, a lot of tax loss selling, and that ends obviously in December, and that's why the market tends to go up in January. But within, I'd say, a week or two, those seasonal factors will be over, and then the market's going to have a very high tendency to decline, because remember, at least in my view, I don't see interest rates coming down anytime soon. The Fed needs to see a clear sign that there is, and this is the key word, there is a sustainable drop in the inflation indexes, whether you look at the PCE, the CPI, the core CPI, the trim CPI, they have to be low, meaning below 3%, and at a sustainable level, meaning they have to stay below 3% for a few months. Then and only then, I think the Fed will lower interest rates. Now, I admit the Fed fund futures are already saying that the Fed's going to lower rates by March, but I do not think it will. And even if the Fed lowers rates in March, they're going to be, and giving you that little hug, they're going to be backstabbing you with continued quantitative easing on the Fed balance sheet. Remember, the Fed can, did I say easing? Tightening. The Fed can still cause liquidity to decline by quantitative tightening, meaning continuing to let the balance sheet run off. Remember, the balance sheet is made of what the Fed buys, mortgage-backed securities, treasuries, as well as adjustments for the Treasury's wallet, as I call it. It's basically the Treasury General Account, as well as adjustments for the BTFP program at the Fed to support the banks. And the last adjustment would be the reverse repos, but that's getting too detailed. My point is, I think liquidity is not going to increase at least until, I don't know, June, July, maybe even September. So I think the market's going to top out very soon, within the second to third week of January. So I hope you all enjoyed this. And if you enjoyed it, please stomp on that like button and subscribe to us. Thank you. And